We're jumping straight into Lumentum Holdings today. Everyone is watching the price action, but the real story is the explosion in AI optical infrastructure.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of laser chips and these massive revenue spikes, do me a huge favor, subscribe and hit the like button.
These do.
It is the single best way to make sure you stay ahead of the smart money and keep getting these breakdowns. Okay, let's unpack this, because if you've looked at the chart for Lumentum recently, it is, to put it mildly, vertical.
It gives you a bit of vertigo, doesn't it?
It does, and you know me. When I see a stock go parabolic like that, my first instinct isn't to buy. It's to ask, okay, who's exaggerating here?
Right. What's the catch?
But I have to admit, the headline numbers they're startling. We're not looking at some vague promise of future growth. We are looking at a hard 65% year-over-year revenue jump.
That's the number that stops you in your tracks. And I think we need to contextualize that, because 65% growth for, say, a software company is impressive. But for a hardware company,
A completely different beast.
a company that has to manufacture physical objects, deal with supply chains, ship actual boxes, that is almost unheard of at this scale.
Right. You can't just copy-paste a laser chip like you can in a line of code.
Not at all.
Mhm.
And this really represents a fundamental rupture in how data centers are being built. They've swung from a pretty substantial loss last year to a solid profit this quarter.
Yeah.
But the market isn't just reacting to good earnings. It's reacting to a huge structural change in the plumbing of the internet itself.
So let's strip this down. They reported their Q2 fiscal year 2026 results. The top-line revenue hit $665.5 million.
65.5.
Which is up from, what, roughly $400 million the same time last year. That is $250 million in new revenue in just 12 months. Where is that coming from? Is this all legacy telecom stuff suddenly waking up, or is this all the new tech?
Oh, it's almost entirely the new architecture. If you look at the breakdown, their components revenue is up 68% and systems is up 60%. So it's broad-based, but the singular driver is this shift toward AI-centric data centers.
It feels like everything eventually comes back to AI these days, but I want to push on this because AI play is a label that, marketing departments love to slap on everything.
Of course.
If I sell air conditioners to a data center, I'm technically an AI play. But Lumentum makes lights, lasers. Explain the connection here. When I think AI, I think of the brain, the GPU, the logic processor. Why is the laser so critical?
It all comes down to the physics of bottlenecks. Think of it this way. We've built incredibly fast brains. I mean, the modern AI processor, like the ones from NVIDIA or AMD, can crunch numbers at mind-boggling speeds.
Unbelievable speeds.
But these models, like GPT-5 or whatever comes next, they are trillions of parameters large. They just don't fit on one chip. They have to be spread across thousands of chips.
So the brain is actually thousands of brains all trying to think the same thought at the exact same time.
Precisely. And for them to think together, they need to share data instantly. And this is where we hit the absolute limits of copper. Traditional electrical cables, copper wires, they have a problem called resistance.
Okay.
When you try to push massive amounts of data through copper at high speeds, the electrons face that resistance, and that resistance creates heat, a lot of heat.
And data centers are already struggling with heat. That's their #1 problem.
Exactly. If you tried to run copper wires between these thousands of chips at the speeds AI requires, you would literally melt the cables or the connectors. Plus, the signal degrades over any kind of distance. You just lose data.
So the copper wire becomes the bottleneck. The GPU is just sitting there. It's ready to work, but it's waiting for the data to arrive.
We call it latency, but yes, it's a traffic jam, an absolute gridlock. The only way to move that much data that fast without all the heat and resistance is light, photonics.
Right.
Lumentum provides the pipes, the fiber optics, and crucially, the lasers that turn the electrical signal into a light signal to shoot it through those pipes. They're building the neural pathways between all the chips.
Okay, that clicks for me. So if the AI chips are the engines, Lumentum is building the superhighways that let the cars actually move at speed.
Perfect analogy.
Without them, you just have a Ferrari idling in a parking lot.
That is a perfect analogy.
Yeah.
And the specific term you really want to pay attention to is data center laser chips.
Right.
That's the product line that's driving all of this. The cloud hyperscalers, Google, Microsoft, Amazon, they are in an arms race. They cannot build these optical clusters fast enough.
Which brings us to the financial turnaround, because looking at the sheet here, the year-over-year comparison is just, it's wild.
It is a dramatic swing. In the same quarter last year, that's Q2 2025, Lumentum posted a GAAP net loss of over $60 million. They were burning cash.
60 million in the red.
Fast forward 1 year, and they've posted a GAAP net income of $78.2 million.
That's a $140 million swing on the bottom line.
In just 12 months.
That tells me something about their business model. That's not just selling more units. That suggests their costs don't go up as fast as their sales.
You've just hit on operating leverage. It is the holy grail for hardware manufacturers.
Right.
Because their factories, their R&D centers, their clean rooms, those are all fixed costs. They pay for them whether they sell 1 chip or 1 million. So once they cover those costs, every additional chip sold is almost pure profit.
And we see that in the margin numbers, right?
We do. Their operating margin hit 25.2%. That's up 1,730 basis points year over year.
Okay, for the listener who doesn't speak finance, bro, 1,700 basis points is?
It's a 17% increase in pure profit margin. It means they're becoming significantly more efficient. Their non-GAAP earnings per share came in at $1.67, which just crushed the estimate of $1.39.
Okay, 25% margins. That is fantastic for them, but here is where I have to play the skeptic.
Of course.
Whenever I see margins that fat in a hardware business, I immediately think competition. High margins attract sharks. If selling these laser chips is just printing money, why isn't everyone doing it? Why can't a competitor just come in, undercut them by 10%, and steal the contract?
That is the multi-billion-dollar question, isn't it? And the answer lies in the extreme complexity of what they're actually building. We're not talking about standard laser pointers here.
Yeah.
We're talking about something called co-packaged optics, or CPO.
We hear this acronym a lot. Let's break that down, without the jargon. What is CPO?
So traditionally, the optics, the part that turns electricity into light, was a separate box. You'd plug it into the front of the server rack. The electricity had to travel from the chip across the circuit board through a connector and then to the optics box. That travel distance creates signal loss, and it uses power.
A lot of wasted energy.
Co-packaged optics moves that function right next to the massive AI chip. I mean, practically onto the same package.
So you are eliminating the commute for the beta.
You're eliminating the commute. But imagine the engineering challenge there. You're putting a delicate laser, which is very sensitive to heat, millimeters away from a GPU that gets incredibly hot. Manufacturing that at scale with high reliability is just incredibly difficult. And Lumentum has proprietary intellectual property and manufacturing processes that let them do this.
So if Lumentum has figured out how to do this reliably, that creates what we call switching costs, right?
Massive switching costs. Once a cloud giant like Google designs their server architecture around Lumentum's specific CPO footprint or their optical switches, they can't just swap it out for a cheaper brand next month.
No.
It is physically integrated into the entire system.
You don't rip out the nervous system of your data center to save a few pennies on a laser.
You don't. And this is what positions them ahead of competitors in this specific high-end AI niche. They are not just a commodity seller, they are a critical infrastructure partner.
And looking at the guidance, management is clearly feeling confident. They aren't treating this like some kind of fluke.
No, the optimism is palpable. For the third quarter, they are projecting revenue between $780 and $830 million. So the midpoint is $805 million.
805.
That would be a new record, again.
So they just did 665, which was a huge jump, and now they were effectively saying, hold my beer, we're going for 800.
That's the message. It signals that the demand for these cloud transceivers isn't slowing down. If anything, it's accelerating.
Okay, so that's the bull case. The revenue is flying, margins are expanding, and the physics of light gives them a moat. It sounds like a clear winner.
It does.
But you know the rules here. If it looks too good to be true, we have to squint harder. I want to look at the bear case, because there has to be a catch.
There is always the catch. And looking at the flip side, the first thing that just hits you in the face is the price tag. Not the stock price, the valuation. The price-to-earnings ratio.
I saw this number. It made my eyes water a little bit.
It's sitting at around 132 times earnings.
132.
For context, the sector average is around 31.
31. So you are paying 4 times the sector average for every dollar of Lumentum's earning.
Which means the market has priced this for absolute perfection.
That's exactly it. A PE of 132 implies that investors expect this exponential growth to just continue for years. They are pricing in the next 5 years of growth today.
Right.
If they stumble, if they miss a quarterly target by even a little bit, or if a big customer delays an order, the stock could correct violently. It's a high wire act.
It is. Now, the bulls will tell you that the E in PE, the earnings, is just starting its ramp. If they keep growing revenue at 60%, that PE ratio comes down very fast.
Sure, the earnings catch up.
Exactly. Some discounted cash flow models actually suggest the stock might be undervalued if that growth persists. But that relies on a very big if.
And I want to dig into the quality of those earnings too, because we celebrated that profit number earlier, that 78 million. But I was reading the footnotes and I noticed something about a one-off gain.
Good catch. That is a detail that a lot of headline readers miss.
So in the recent numbers, there was a $31.9 million non-recurring item, basically a one-time gain. So I just grabbed a napkin, did some quick math. If you take the reported 78.2 million in profit and you subtract that 31.9 million,
You're left with about 46 million.
right, 46 million in core profit. Now, don't get me wrong, 46 million is still way, way better than the loss they posted last year. They are still profitable.
Still a great number.
But it's not 78 million.
No, it's not. And that means the clean earnings per share is actually lower than the headline number.
Which means that 132 PE ratio we just complained about,
Uh-oh.
it's actually even higher if you strip out the one-time bonus.
It is. It makes the valuation look even more stretched. It doesn't break the thesis, but it definitely clouds the picture. It means the core business is healthy, but maybe not quite as superhero-level profitable as the net income line suggests.
Got it. What about the balance sheet? I know historically that has been a weak spot for them.
It has, yeah. Their cash flow coverage of debt hasn't been stellar in the past.
No.
It is improving now as the revenue scales up. Cash fixes a lot of problems.
It does.
But they are carrying debt, and they need to keep generating cash to service it comfortably. It's not a red flag right now because they're growing so fast, but it's a yellow flag. If the economy turns and orders dry up, that debt becomes a weight around their neck.
And we can't ignore the competition. We mentioned the moat earlier, but they aren't the only game in town. I mean, companies like Coherent and LITE are massive.
They are. This optical scale-up market is fiercely competitive. Lumentum has a lead right now with their specific CPO tech and these laser chips, but Coherent and TIEs have very deep pockets and huge R&D budgets.
Right.
They are not going to just let Lumentum have the entire AI market without a serious fight. Lumentum has to run fast just to stay in the same place.
So the moat is there, but there are heavyweight contenders circling the castle.
Always.
Okay, so let's zoom out. We have a company sitting at the center of the AI storm, growing like crazy, but priced like it can do no wrong. For the listener holding this stock or, thinking about it, what are we watching? What are the signposts for the next, say, 30 to 90 days?
The biggest one on the calendar is the next earnings report. We're looking at late April or early May of 2026 for that Q3 report.
And we're watching that $805 million number.
That is the line in the sand. With a valuation this high, they cannot miss. If they hit $805 million, the thesis holds. If they come in at, say, $790, the market might punish them heavily. You have to see them hit or beat that revenue target.
And beyond the specific company numbers, what about the big picture? I feel like we need to watch the customers almost more than the company itself.
Absolutely. You need to watch the macro news around AI infrastructure broadening.
Broadening? What do you mean by that?
So for a while, the trade was just NVIDIA, just the chips. Now we're hearing about energy demands, cooling, and cabling. If you see headlines about rotation from software to hardware or increased CapEx spending from the big cloud providers, Microsoft, Amazon, Google, that is a direct tailwind for Lumentum.
They sell to those guys.
Exactly. If those guys are opening up their wallets, Lumentum is catching the money.
Right. So if Amazon says we're doubling our data center budget, Lumentum shareholders should be smiling.
That's the signal. Also, keep an eye on institutional moves. We saw that funds like Fidelity Growth Strategies have been highlighting the company in their letters.
Why does that matter? Fidelity's huge. They buy everything.
It matters because it signals smart money accumulation. When these big institutional funds start highlighting a position in their investor letters, it means they have high conviction. It tends to provide a bit of a floor for the stock price because they're accumulating shares over time. So if you see more large funds disclosing positions, it's a big vote of confidence.
Okay. And I did hear some rumors, some speculative stuff about them entering a new market.
Yeah, there is some chatter about the optical scale-up market, specifically ramping up by late 2027. This is speculative for sure, but if we get any kind of official news or product announcements confirming they are entering new segments of the optical stack, that could be a major catalyst.
Because it would mean their total addressable market is getting even bigger.
Exactly. It expands the whole story.
All right, let's wrap this up. This feels like a classic pick and shovels play. We aren't betting on which AI chatbot wins. We're betting on the fact that they all need to move data fast.
That is the whole thesis. It's a multi-year playthink, 2026 to 2028, on the physical reality of AI. The software is magic, but the infrastructure is pure physics. And right now, Lumentum seems to be mastering the physics.
Here is the lowdown. Lumentum is posting 65% revenue growth and record guidance because they are the plumbing for the AI revolution. The stock is expensive at 132 times earnings, especially when you strip out those one-time gains, so it is not for the faint of heart. But the operational turnaround is real. Watch that $805 million revenue target in May like a hawk.
Couldn't have said it better myself.
And I'll leave you with this final thought. Everyone talks about the AI brains, the chips in the software. We are obsessed with the processing power. But without the nervous system, the optics that move the data from neuron to neuron, does the brain even work? Lumentum is betting they are the nervous system, and right now, the market agrees. Thanks for listening to the Easy Money Show. We'll catch you on the next one.